we are live.
All right. Good morning, everyone. Cassidy, if you could please do a roll call.
Okay, this is the Investment Advisory Committee meeting
Yes.
for December 11th, 2025. And present, we have Eileen Stanek, Commissioner Christian Bennett, Commissioner Crawford, Miss Jamie Jones, and Miss Jackie Petty.
All right, thank you. All right, has everyone had a chance to look at our meeting minutes from last month, or the last time we met?
Yes.
I should say last month.
Last
It's been
meeting?
September.
Yep,
Yeah, our
September.
last meeting.
Mhm.
I didn't see any issues with it.
I did not either.
Okay, so I'll entertain a motion to approve or accept the meeting minutes as presented.
Second?
Okay, roll call?
Jill,
Yes.
Sabrina,
Yes.
and it's Jamie.
Jane.
Yes.
Okay.
All right.
Okay, next, Eileen is on.
You're up, Eileen.
Thank you. I just push for you.
Let's hear some good news.
Yes.
Let's hear some good news, Eileen.
Yes, I know, I've been the bearer of good news for a couple of years now.
I know.
Yeah.
We want you to continue that.
Yes,
I
please.
know. Well,
Yeah.
the Fed did lower rates by 0.25%. That was fully expected by the market. And of course, the rationale or the support for doing so was the fact that the labor market has continued to show signs of weakening, softening. Despite the fact that we still don't have current updated official data coming out of the agencies, particularly on the labor market. Last data we received was from September. We also don't have official data on inflation. The inflation data will not be issued until next week, and they're actually, we're, in both of these data sets, we're going to have a break with 1 month of data not even being reported because the government was shut down and there weren't, that process wasn't in place to collect the data. So not only the Federal Reserve, but the market has relied upon what we call public sources, private sources of data, and things like the ADP employment report. ADP is one of the largest processors of private payrolls, and so they are able to, and they do, release data sets as it relates to employment numbers, at least in the private sector, for their client base. So that represents just a slice of the labor market. But the trend that we've experienced in the first portion of this year, from the ADP data, we expect that trend to continue, which is a continuing softening in the labor market. Clearly, when we look at some of the anecdotal evidence too, just as it relates to consumer spending, we still have this environment. The higher wage earners, yes, are still able to travel freely and spend money freely. The middle income folks and the like are feeling very much the pinch, and that has been accelerating even so. There's been a lot of talk about this buy now, pay later financing mechanism, which is heavily used by a lot of folks. This is kind of data that's outside of the banking industry. So, because when we think about credit card data and the like, that's all within the banking industry. So this is like off balance sheet to some degree. But there's been a call for these organizations, the companies that do provide these programs, to be more transparent in providing data as it relates to delinquencies and defaults and such. Because there is concern that that portion of the financing side could be problematic, particularly for the consumer and ultimately for the banking industry, because many of these organizations, they get funding through traditional banking methods, through banks, through maybe private equity and the like. And so as we've learned, everything is ultimately interconnected, even if it's not on the balance sheet of the banks. So that being said, yields, rates, they had continued to drop down a bit. Again, kind of everybody's running with limited data, but following the basic trend, which is a slowing economy, and therefore that supports lower yields. We know that, of course, the new administration, many of the programs, the tax policy and such is geared to be pro-growth. We just haven't seen the results, the impact of that yet. We know some of that is going to occur in '26 when the tax adjustments from the big beautiful bill come into play. So that will provide should provide some relief, at least also some positive impact to the consumer. But again, if we have a good portion of the consumer who's very stressed, it will just hopefully help things from deteriorating further. So one of the things that we always look at is what is the Fed funds futures market expecting. This is, of course, the graph from the day before the Fed lowered rates. So we now have that December 10th meeting behind us. The market was expecting that rate cut, as we could see, looking at that 3.66 on the blue bar. Looking to the expectations for all of '26, it's interesting that really the market's expectations for '26 are not, even though the Fed did lower rates and issued some updated guidance. And the reason it's not really changed is because the market is looking at a couple of things. Number one, they're looking at this, softening labor market, looking for it not to, really turn back up, looking at inflation, not expecting that to turn back up, looking for that to continue to stabilize, but also looking at the standpoint of we have Fed Chairman Powell's term as Fed Chair ending in May, and the fact that there will be a new Fed Chair assigned or appointed then. And as we know, that will be based on an appointment by President Trump, and the current running person who's in the running, he hasn't announced a decision yet. We know that. He keeps saying he's going to, but he hasn't yet, is this gentleman, Kevin Hassert, who's the Director of National Economic Council. So he is clearly, within the administration, he is supportive of lower rates and the benefit of lower rates to help keep the U.S. economy growing. He has publicly acknowledged, though, the need for the independence of the Fed, as well as recognizing that it is a committee. And so his job will be, of course, based on, as they look at the data and they absorb all the data, is to help to guide the committee to an outcome that, as he has a stronger voice, feels is appropriate for the U.S. economy. Now, when we go into 2026, we will also have the rotation of those Federal Reserve. They do rotate out as far as being on the committee and who will be voting. So that process will be underway as well. And as we can see, we'll have some new members coming onto the committee who have, and I want to say all of the Federal Reserve presidents always are out there talking about their outlook for where rates are headed, but they're never, if they're not a voting member, you can say all you want, you're not impacting.
It's not gonna matter.
Yeah, exactly. But now they will be in a position to actually be part of that discussion. And as we can see, it's maybe a little more challenging because some of the folks coming in, some think it's appropriate just to keep rates kind of where they're at, versus yes, there are some who do support the fact that rates should be lower because the labor market it has been softening. So we'll have some new dynamics in 2026, a lot of challenges, and really when we think about how the market is interpreting this, is the market is really looking for the next rate cut around the time when the new chairperson will be in place. So maybe nothing really will change from interest rate standpoint until we get a new chair in place, and that's where basically the market is placing their bets. Market is also expecting another rate cut in 2026, so that would give us 2 more rate cuts in 2026. So as we know, that would continue to particularly drive down those short-term interest rates, particularly the overnight rates. On the inflation side, forgive me, I gotta change the page here. We did get one update, but it is really a very stale update, which is the September inflation number. for the personal consumption expenditure. And it did tick down a little bit, so as we can see, inflation is still higher than the 2% Fed target, but it has been stable, relatively stable. It's not been moving up significantly or not moving down significantly. And when we think in terms of what the Federal Reserve's mandates are, it is stable prices. May not be at the level they like, but prices have been stable, and of course, full employment. And we know the risk now to the economy is more so on the employment side. Growth, we don't have official numbers yet, but private sector numbers that we are seeing are kind of indicating that growth for the fourth quarter will be down because of the government shutdown, and so that growth though will be pushed over into 2026. But again, growth expectations for 2025 and then 2026 is still slower growth, but no one is forecasting a recession, which is a good thing.
Yeah, very
Yes, very good.
Yep.
But as we know, this all can change. And again, the other factor too is, next year we have those midterm elections. So we don't know what that impact will be yet. It's too soon to call. Labor market and the payroll data, this is the, each bar is the monthly job growth or job losses in the US economy. Again, we only have official data through September. And we can see we did have over the second half, thereabouts of 2025, we had 2 months of job loss, net job loss. So rather than job gains, we look at this trend also of job growth. The orange line, job growth has definitely slowed down significantly. This morning we did receive the initial claims for unemployment. That number was up, which is not surprising because when we think back, there's been several rather large announcements about companies laying off people. Whether it was Amazon or I think it's Verizon, in their headquarters, large numbers of people, again, result of their recognizing the efficiencies they could gain from implementing AI. But then additionally, I think companies are going through this period whereby we went through a long time where it was very hard to find workers. And so companies had a tendency to retain the workers they had rather than right-size their staffing based on post-COVID life. And we think now we have this window where companies are not only looking at AI, but also then taking it as an opportunity to look at their full staffing and saying, well, there's not as much job creation, so consequently if we right-size, we need to hire people back, it should be an easier find. I would argue, based on our experience, it is difficult still.
Because people want security.
Yes.
I mean,
Yes.
some people will. I've
Right.
had people come back, but for the most part, you want to go where it's your livelihood.
Yes, exactly. Yeah, I agree. I know, we read some of this, opinions that come out and analysis and it just goes it's counterintuitive to what you think that's just coming to a conclusion based on maybe some data, not really looking at the broader picture, right? Which is, yes, people, if you lose your job from a company and then 6 months later they want to bring you back, you're probably going to have either found another job or you're going to say, I know.
Yeah.
I'm going to
Yeah.
figure out something else here because you treated me bad or whatever. But irrespective, what we're seeing now too is this kind of narrative also entering the picture here where the folks are saying, well, does the U.S. economy really need to create as many jobs as they used to in the past? Because, again, with inefficiencies, I have to say, this is one thing that's on my list to read into further because there's that pessimist in me that says, wait, is this just folks are trying to come out with a narrative that supports the fact that we have had such slow job growth, to say, oh, well, we really don't need that many jobs, so this is okay. Versus, I don't feel that it's okay, for the U.S. economy to not have some solid job growth here throughout this time. But again, we don't have official numbers, so we don't know what the last numbers have been. We do know the unemployment rate at last read was up to 4.4%, But interest rates clearly have been, like we said, they've been coming down. Here we're looking at the orange line, or orange line is the, that overnight Fed funds rate. This is where it was right before,
Where they dropped it.
yeah, before they dropped it, and this is the 2-year treasury. So it's interesting because we can see that these two yields, they do follow the same direction. Generally though, the 2-year treasury leads the overnight rate, generally by about 6 to 12 months. And so the fact that we were in this inverted yield curve period, or, you know, everyone kept saying, oh, we're gonna, you know, the curve is telling us we're going to have a recession. That's been the recession that never
Yeah.
came. It kept being
Yeah.
pushed out every 6
Correct.
months. But it's interesting today, I mean, the 2-year treasury really hasn't moved, and yet we know overnight rates have dropped. So we are starting to get back to a period where, feel that, you know, we'll be in a more normal yield curve environment.
Yeah.
Just not there yet. All right. Again, all of this supports what we've been doing, which is, you know, continuing to invest funds, to lock them in, to be able to continue to provide that good news on the interest income side, yes.
Yeah, that's the good news.
Yeah, definitely. So looking at the portfolio, you know, cash is down, relative to our total investment. We're down to about 9% of cash. Now, I know that, you know, Jamie and I had this conversation here before coming in. They're monitoring that very closely.
Yeah.
And we know we have other, you know, sources to go and, restore some of that money if need be, to move things around, as you get very close to year end, when those last, AP runs and payrolls go out. So clearly something that's being monitored, but this is very typical that we know December is a low point. And so coming into December with a low percentage of cash relative to investments is very typical. And so once, you know, tax collections come in and the like, then we'll be back to our normal stance. Portfolio of $188 million invested in securities, currently yielding 3.84%. That's up from last quarter's 3.68%. So certainly some improvement there. And of course, you know, as funds we had lower yielding securities falling off, reinvesting in higher yielding securities, that becomes very accretive to the interest income numbers. Looking at our maturity distribution, we can see that our allocations across each of the maturity buckets, it's relatively stable. And that's a function of, you know, as we look at, you know, particularly a yield curve that's now relatively flat, we look at an economy that, yes, it's slowing, but we think, you know, at some point that longer end of the curve is gonna move up. We wanna make sure we're going to have maturities rolling down to be able to take advantage of that. And then in addition to having kind of that backup liquidity that, again, as we know, you know, there's, you know, perhaps some, when we get into 2026 capital expenditures or paying, spending out the remainder of the ARPA dollars. That may require some money coming out of the investment portfolio. But the securities that are maturing beyond 2 years, on average, we have that locked in at 4%. So, again, having been able to methodically get those funds reinvested and locked in. And our anticipation is, this quarter, we have just under 8 million maturing, so again, a small percentage of the portfolio over the next 3 months. We would still look to put that out longer term, so that we're maintaining those longer term exposures and locking that income in.
So, sorry, Eileen, when I looked at our last report, which was in September,
Yep.
like the 4 to 5 year bucket, it was at 14%, now
Yep.
we're at 21%, so that just kinda shifted, right?
Yes,
So,
yes,
yeah.
exactly, right.
Yep.
Getting things locked in, yep.
Mhm.
Very good.
Yeah. And so we can see that again on our recent purchases.
Yeah.
Forward.
Yep.
You know, the maturities that we, as funds were reinvested, were predominantly out longer term. And so that contributed, to your point, with, you know, getting those funds, you know, more so in that longer bucket, which locked things in. On average, funds were reinvested at 3 3/4.
Yeah, because we know all good things come to an end.
Yeah, they
And
did.
those interest rates will fall
Yeah.
asleep.
Well, the good thing is, the good news is, one good bit of news is that, you know, the Fed issues what they call their guidance on what they believe is the appropriate rate on the longer term basis, and that rate is 3%. So the expectations are that barring any crisis event, which of course we know in crisis events, the Fed reacts by dropping rates to zero, that kind of the bottom, the floor, one would expect, barring even a recession, would be around 3%. So clearly, that is also a much higher rate than what we had experienced, during the, coming out of the housing crisis, and of course, even during, but we still wanna make sure we get things locked in well in advance of 3, because if we have a downturn, then the Fed will lower that longer run, guidance. So, looking at our projected interest income, based on the securities we have in the portfolio today, this does not assume any reinvestments. We can see that for 2025, actually, which we're about closing that out. We're expecting just under $6.5 million for 2026. Today we have about 7.2 million of interest, so a continuation of the good news. And 27, again, because it doesn't reflect reinvestments, it's still even at over 5 million, 5.6 million or so, still at a level that exceeds 2024. So being able to continue that trend of extending those gains, I would say out into the future, even though we have been in this environment of rates falling, the objective, of course, is to continue to provide that stability in the interest income. Yeah, and this is the historical view, just going back in time. Yes, we definitely don't want to see those portfolio rates like we had in 2012, 13, and 14, under 1%, close to 1%. Well, and even 2020, 21.
I was
gonna say 20 and 21
Wasn't even
was
a million.
not
Yes.
as good.
Not good.
Yeah.
But we
Yes.
got very spoiled.
Yes, exactly. Well, and it's interesting because in 2018, we were coming out of the Fed was finally moving rates up, and so was the market as well. And everything was starting to move in a more positive direction, and then of course COVID hit. And pulled the rug out from underneath it. But needless to say, right, we were able to rebound that fairly quickly here and build upon it. And then the last portion, of course, of the report is the actual portfolio holdings. These are the pages out of the monthly statement that we prepare and provide to the treasurer's office with all of the detail. Okay? All right.
Good. Does anyone have any questions for Eileen?
I do not.
All right. Hearing none, we'll go ahead and move to other business. I don't know if you have anything on the investment policy updates.
I do
Since
not.
he's not.
Yeah, we're just gonna
is that-
postpone that to the next.
Okay,
meeting.
that's fine. Yep, that's fine. All right, and I will accept a motion to adjourn.
We'll make a motion to adjourn, or?
Yep, do we have a second? I'll second. Okay. All in favor?
All in favor.
Aye.
Aye. There we go.